You're listening to the Applied Blockchain Podcast, hosted by Ben-Ari, founder and CEO of Applied Blockchain. Today's guest is Ziv Keinan, a tokenization and real-world asset expert and curator of the STG-3 RWA Community, working at the intersection of digital securities, markets, and strategic partnerships. Ziv draws on years of experience spanning law, private equity, and blockchain infrastructure.
Ziv Keinan, welcome to the Applied Blockchain Podcast.
Thank you for having me, Adi. It's good to see you again. A bunch of OGs.
A couple of OGs, certainly.
Yeah.
Let's see what we can dig up from the past here. Tell us a bit about your background, how you got into the space, what you're doing here.
So I have a diverse background. I came into the space from the legal world. I was a lawyer for about 15 years. In 2017, I started working with blockchain companies. My risk appetite was low, so it wasn't the usual ICO that was at the time. It was actually trying to launch a compliant ICO, what was called at the time STO, security token offering. We were working with different companies from around the world and were compliant mostly with US regulation around launching securities, so complying with Regulation D, 506C, 506B, which is the exemption from prospectus requirement under the US law. That is where I started. That also led me to some of the wonderful people that are still operating in this space right now. In 2017-18, I started the RWA community, the STG-3 RWA community. This community is rural and it's now 250 person, and it's executive from around the world, people that I've collected over the years that are managers in the space, and you are also part of this wonderful community. The event that we're doing in London is part of the community. We'll discuss it soon. Completing the background information, I later went and did some executive roles. I was legal lead for one of eToro's project. eToro is a large trading platform, and I still have very good friends from there. I was a part of the founding team of a company named Onera, a UK company that does the interoperability solution and now collateral management for financial institutions. And JP Morgan, it's among one of its investors. Additionally to that, I also had a startup in this field that was tokenizing the market for trading of shares that are about to IPO. It's called the pre-IPO market. So very large company, private company, doesn't want to, like Revolut, doesn't want to go public, but still, there's employees, executives that hold shares. They need to trade it somehow, exercise it for money. It's a very big problem in the financial world, and it's currently not solved. So my company was about that. We ran with it for about 3 years. We had about $500 million in assets that were traded on our platform, but eventually we decided to close the company because we couldn't achieve some of the KPIs that we had. And right now I'm working as a consultant in this field.
Okay. Well, that's probably almost a decade, right?
Yeah.
Let's break it down a little bit. So what was the year when you were looking at the STO? And what are we talking about here? Was that...
Yes, I think, 17 until 20 were the years of the famous STOs. The reason why STOs came to life is that there were companies that were looking at, the amount of money that were raised through ICOs. They were more established companies, startup, but more like in a, early growth stage. And they thought, we want that. We want the value, we want the money. But it was also very efficient, right? You can argue it's not compliant, but the way that you raise money through ICO, that's the way that money should be raised. Like you put something on the internet and you use the power of the internet to draw investment. And settlement of those investments takes seconds. And, you just exchange your token, your initial token for a token that has a value, whether it's Bitcoin or something else or stablecoin. It does make sense. And also this is what led me to this space, because the efficiency that you see in the blockchain space, it's something that does not exist in the real economy. In the real economy, to launch something like that, on the operational perspective, you need to, send money from banks around the world to the same account, and that's complicated. From, regulatory, then you need to go through, accreditation tests and, to verify that you're compliant with securities law globally. So not only on your country, but, wherever the investor is located, you need to comply with securities law. And then privacy, AML, those are all things that needs to be considered. And again, like we thought about, we have an idea about how to do it in a compliant way, and that's exactly what we did.
But I guess that in many ways, at least back in 2019, they were almost two different worlds, right? Because you had these ICOs and you had tokens being created by projects. The projects would publish a white paper, right? In a good case, yeah. If they would have had ChatGPT to create it, then they would have done it, yeah. Many of these tokens didn't represent anything legally, right? There was no commitment to anything on the other side, right? So I think it's interesting because it's not just like looking at. I mean, obviously you look at it from a regulatory and legal perspective, but I look at it also from like what was actually going on here, right?
Yeah, but I want to. But I want to also say, people are not stupid. The people that invest in those projects. No, again, like they're not stupid. People invested because they wanted to make money, and even if you look at the tokens today, I work with a company, layer one named XDC. If I could have bought XDC at the ICO, it went out, thousands of percentage. Like so that place is exactly the place where, and XDC, by the way, they exist for 7 years now. It's like a very OG project. So not everything was a scam, and the idea behind those tokens, yes, it does not give you a right in the equity of the company, but it gives you the currency of the network. So each network is like a small economy, and that economy has some kind of a insider currency. So if you want to interact within the economy, if you want to send transaction, you need to pay some gas, and that's why you need the token. That's why the idea was, or the thinking was, the thesis was that if there's a lot of people using the network, then the price of the token itself will go up. And actually, and that also gives room for speculation. So speculative investors come into the space and say, okay, I see that the use of the network is going up, so I'm going to buy the token, not to pay for gas, but because I think the value is going to go up. Mm-hmm. And it actually did with Ethereum. With Ethereum, it went so up that at certain point, like I think at around $600 Vitalik went out with a notice saying, I don't think it was that much. You shouldn't buy it. It was $600. How much is it today? Like 5,000.
Yeah, it's probably gone down a little bit in the last month, but yeah, I think it's around like 2,000 or 3,000. But I mean, I say this as having a candid conversation. We've both been around throughout this period. I struggled, and in some models still struggle to get my head around it, right? So the way I look at it, if it's a decentralized network, let's say like XDC or Ethereum, you effectively have outsourced hosting, right? That's the way I think about it. So your validators are different participants that have to be paid in order to cover their hosting costs, and they want to see some profit as well, which is fair, right? So those validators are paid using the token of the blockchain, and I think that's the only fair way to do that, because if you pay them with US dollars, so that means somebody's holding a US dollar account and can stop paying and therefore shut down the network. So there's actually like a valid reason to have a token. It's almost like the only way to actually have a software-generated token by the validator node in order to have a decentralized, in terms of controlled network, right? So that I can understand, and people pay gas fees, and there's a covering of cost, and there's a profit there, and that's what we call staking, right? It's kind of creaming off that profit from the validators. Everything else, I'm still struggling with, right? If you're not hosting nodes, then it's a little bit different, and also the staking profit I can understand. The token going up, I think, and I'm not a token economist, but my observation would be it's because people are holding it, right? And that's because of speculation. So I think if Ethereum is going to validators, if ETH is going to validators, and the validators are then cashing in on that, and then people are buying that and using it to pay for gas fees, that's just a circular economy, right? If the token isn't being actually held anywhere, then there's no, I can't see a reason why there'd be a demand-supply pressure point. It's just circulating. People get paid, they pay. They get paid, they pay. Yeah, I think the pressure point comes if it gets held, and I think that's what's happened. Is people hold it because they're going that because they perceive that there'll be a long-term usage of it.
Never underestimate the power of speculation.
I mean, that's fine. It's fine. It's legitimate.
And
right?
speculation is. I want to say, I wish I was taught more about speculation when I was younger. I think speculation is a very important part of your portfolio, and people don't speak about it. And most of the people that I know that became extremely wealthy have done it through speculation. None of them done it through buying the S&P 500. So
on this I completely agree with you.
And the world is that walking that way that is very hard to predict. What's going to come. I think for years, obviously 2018, 20, what we were speaking is like, it's the year of speculation was skyrocketing. 100%, because there wasn't a product market fit. We didn't really know what it's going to be used for, right? We're still not sure, right? We're still like, we see some product market fits. We see a product market fit with payment, with stable coins. It's very obvious. We see a product market fit with prediction markets. That is really interesting, very recent. We know that NFTs are not a product market fit, right? It's a very speculative market. We know that there's other things that are not a product market fit, and we know, and we started to understand, just a second, we started to understand that securities traded natively on chain, not, again, 2018, 2020, Securitize going up to the market saying, hey, we'll tokenize this, we'll tokenize your shares, you're a startup, I'll tokenize your shares and you'll be able to raise a lot of money. So we know two things about it. First, most of the startup then didn't raise a lot of money through tokenization, didn't really work. Second, it wasn't the pure form of tokenization. They went to speak to the regulator, and the regulator said, you're actually going to register shares on the blockchain. They said something about, no, we're going to have a transfer agent. The transfer agent is going to manage the records. The only valid records are the records managed by the transfer agent. And the blockchain is just a way to do this registration. Could be an Excel sheet, could be
it's a database for this, right?
Exactly, a database. So it's called like a proof of registration. But now we're starting to see something else coming, which is very unique. Franklin Templeton Bungie one, BlackRock just this week launched BDL on chain. We need to see what does it mean. As I said, like we're doing this 11 days. We're doing RWA London Summit in one mortgage place with participation of mainly most of the asset managers, like the BlackRock, Fidelity, State Street are going to be there with, the banks, Lloyds, Citi, Barclays, JP Morgan, and NatWest and others. And what I know from speaking to those guys ahead of the event is that they're launching on-chain product. They're launching on-chain like tokenized money market funds and other products. And they're launching stable coins. There's a lot of interesting stuff going on. Going back, we started was 2018 to 2019. It was a lot of speculation. We actually didn't really know what to do with it. Right now, we're starting to understand how it's going to be used and what's the revolution that's going to come out of it. And I can tell you 100% that some of the speculators at the time that, invested in those projects, they made and are going to continue to make a lot of money. I understand the criticism, but eventually, the proof is in the pudding, right?
Yeah, I mean, I have maybe a different perspective to some because I didn't, and arguably I should have looked at it from a speculative perspective. I looked at it from a purist, techie, value perspective, and that was maybe the wrong perspective to look at it, right, with hindsight. But I guess that's where I come from, and that's still how I look at things. When I look at the securities market, right, and real world asset tokenization, I guess I see a couple of things. I see a lot of a lot of players wanting to play in this space. I see a lot of players taking one or two steps to put something on chain. But I don't know what, I don't think we're seeing yet a meaningful volume in terms of buying or trading these assets. Right? What's going on?
I don't know if you've seen this video. You see this guy like outside, and this guy is on the grass, and it just, just some music, and this guy started dancing, like a little bit funky, a little bit strange, and suddenly someone joined him, and it's like two people dancing. And now two people are dancing strangely and funky, and additional people, and then you see like an hour later, like 300, 400, 500 people dancing. So we're like in this stage where, we have this, very early people that were, taking the risk, promise things that sometimes they could, sometimes they couldn't deliver about. And the promise was tokenization of equities. All shares would be on chain, whether public traded shares, NASDAQ, London Stock Exchange, or all private shares, which is what I did with my previous startup, trying to tokenize the market for trading of private shares. And so we were early, and we were failing a lot and burning cash. But, suddenly people start coming, dancing around us. And those people, it's not like small players. There's like BlackRock, coming and, they're joining, and they launch Biddle. So Biddle is.
I think BlackRock is. I mean, what they've done is really incredible.
Yeah.
Because they haven't just tokenized a product, a money market fund. They've tokenized it on a public blockchain, right?
Yeah.
They tokenized it on Ethereum.
They did.
And now this recent announcement is they plugged it into DeFi, right? You can use
Insane.
it with Uniswap.
Insane. Right? So that's exactly what I'm saying. So BlackRock was there. Again, it was very segregated. It was the minimum risk that you can take when launching a product on chain. Still with a transfer agent, and Biddle is open to, a lot of people don't know, but Biddle is open to qualified investors, not even accredited. Accredited according to the US law, you have to have like 1 million in US dollar, or, there's all kind of accreditation tests. Qualified, you need to have 50 million, so it was opened only to those sizes. But then what happened is that stablecoin issuers like Ondo, they went and used it as a collateral for their stablecoin. They created another fund. The fund was invested in Biddle, and then was used as collateral. So the risk was transferred out of BlackRock. So there was very early project, and very, trying to take the lowest risk possible.
Well,
now,
yes and no, because in terms of infrastructure, they went on a public network. That was what I thought was huge. Because you saw, and you still see, many institutions deploying on private networks, or Canton, which is essentially a type of private network, and so going on straight onto public Ethereum, I think is not, it does carry risk, right? Maybe with hindsight it seems fine, but at the time I think it was pretty radical. And the same thing with Uniswap.
Yeah, I agree. That the 100%. We both, are experienced in the cybersecurity space, so we know that a public blockchain are highly adversarial environment. Again, they did it in a very trying to minimize the risk, but I agree with you. This is.
But also control, right? It is a decentralized network, so it's not like a private blockchain where I have my node, I send it to a counterparty. There's no one else gets it. This is this is an open environment.
Let's go back to how it's built. There's someone that's managing records behind it, and if someone hacks and steal the token, they can burn the token, issue new tokens. There's all kind of safeguards around it. But as a first experiment, it's nice. So I just want to say, what I started saying is okay, so BlackRock did it, and what happened is that first it's blew up. Everything about stablecoin, by the way, I think that asset managers and banks are looking at it and saying, oh my God, so much money there. How come I'm not there, right? How come you're seeing Circle, we're a financial institution. We should be the ones that issuing those stablecoin. How come Circle is capturing all the value? How come, So they were late to the game. They needed Circle to come in, take all the risk. By the way, Circle, from a regulatory standpoint, it's very clear that the U.S. administration wanted this project to come to life, and for the dollar to stay dominant in the crypto world. And that's why, because from a regulatory standpoint, I think, if someone wanted to challenge Circle, specifically in the early days, they might have a good use case.
That's an interesting insight. Okay.
Yeah. Yeah. I think 100% when the US administration was fighting ICO, filing lawsuits against ICO entrepreneurs, blockchain entrepreneurs doing ICOs, claiming that everything is security. At the same time, they had a very straightforward strategy to maintain the dominance of the dollar on-chain. So they still believe that it's going to happen. And what I wanted to say before is that once BlackRock joined, the other asset manager started looking at it seriously, and the banks start looking at it seriously, and they all had like those small departments of digital asset innovations teams where you come in, you present your startup project, and then nothing happens. They never call you. I was with Onera. I remember, we were speaking to one of the very large banks. It was just before COVID. So it seems like things are going okay, but first, they didn't have any plans to go into production. It was all like POC after POC, and nothing was real at the time. And we were asking ourselves, like, when is the institutional coming? Okay, when? When it's going to happen. And then when COVID started, they just stopped picking up the phone. They had so much to do, right? Things are changing, this current US administration brought clarity to this space. It's nullified the sub 121, which is one of the things that prohibit institutional to get into the game of custodying digital assets. The Genius Act, the Clarity Act that is about to be enacted, that sent all the big banks and asset managers, just to launch product. And right now, there's a FOMO where one launches, the others, immediately start thinking, okay, why aren't we launching it? Or what are we missing here? So JP Morgan,
is someone getting ahead of the game?
Yeah, exactly. JP Morgan launching a JP coin on Base. Yeah, you're probably familiar with the project.
Yeah. We have another podcast episode with Emma, who's one of the product managers.
With Emma, really? Oh, amazing. Yeah, she's going to be in the event as well. She's going to be at RWS. Yeah,
24th of Feb.
Yeah, 24th of Feb. Yeah. Amazing. So JPM launched a coin, and then of course the other banks are saying that, and they're thinking, we should do that as well.
Yeah, amazing. I love the analogy of the crowd, the dancing, because at the beginning you're kind of, okay, should I be doing this? I feel a bit stupid. Everybody's looking at me, and then in the end, it's like you're feeling like you're missing out if you're not having the fun with everybody else. So
100%.
Yeah, I think that's brilliant. So Ziv, I guess going back to where the market is right now, right? So we have a series of platforms out there where you can tokenize, right? I mean, there's Archax that we work with, and some institutions have their own, and people are tokenizing. And these are securities, so they have obviously restrictions around them, right? They have white lists. You have to go through the certain parties in order to be able to buy the asset, and so on, right? What needs to happen in order to have buying of these assets in large quantities? Because I can see, certainly as a techie, I can see the promise. You put it onto this infrastructure, it's very efficient. It's a bit like you said, the ICOs, the tokens, and so on. You can see how it can all become very efficient very quickly. But it needs people to come and buy these assets.
Yeah.
What's do you see anything there?
So if you ask me as a lawyer, a few years ago, whether you can take a share or a bond and register on a public blockchain, I would probably say no. Securities should be traded on a securities exchange. It's like very, very clear, right? When they are traded on securities exchange, you can see that they're monitored for they're surveilled, monitored, everybody's KYC, there's all kind of processes.
Disclosures and things.
Disclosure there, and disclosure is okay because you can take like an Apple share and write it, like Back did, and put it on the blockchain. And the disclosure is still there, but who monitors the trading? Making sure there's illicit trading and so on. So, but again, we started seeing that it is going that way. We started seeing on-chain products, and I think this is a very interesting development, and I think it's also going to affect the market. It's going to affect blockchains. We just seen a new blockchain launched named Zero, right, by Layer Zero, which is another layer one, and everybody is like, why do you need another layer one? Actually, if you're going to tokenize all NASDAQ shares and everybody is going to trade 24 hours, and you need another layer one, maybe something which is technology more developed. So maybe the infrastructure needs to be updated as well. So I think there's actually development in the space. What did you? I forgot that the original question.
The question is really the buyers.
Whether the buyers
because if I think like BlackRock, my understanding is that the main market for buying that asset initially, at least, was crypto treasuries. Right, so entities that are holding crypto can switch in and out of the BUIDL token and therefore hold a different type of asset. Right?
I think I understand the question. The question is like, are we launching those products in order for the crypto people to buy them?
Yeah, how do we break out into the mainstream?
Yeah, I don't think so. No, I think when State Street and BNY are coming into the space, they're the buy side. I think they're about launching it, but also about buying it. And if you can bring additional yield, that's what they're doing. That's what they're selling. If you can bring additional yield, additional efficiency, if this generate more yield than traditional instrument, or you can do more with it. So in the DeFi space, there's a lot of things you can do. You can easily stake product, take leverage against, loop it, I don't know, get like a certificate when you deposit. I know I have a portfolio with my broker, I have, all kind of shares. And so I never got a certificate of holding these shares, which I can actually take and do something with it. But in the DeFi, that's how it works, right? You can, invest in DAI, you're getting a C DAI, you take the C DAI, you can leverage against it. There's all kind of innovation in the DeFi space that I think is going to trickle down to this economy.
That's kind of composability, what you're talking about, right? I've got one asset, I can take it from over here, deposit it over there, move it around, take something else and put it here.
Yeah. So I think institutional are going to join as the buyers, not only as the issuers. But if they're only joining as the issuer, I think they're going to be unpleasantly surprised because there's not actually in the crypto space it's not. I don't think there's a lot of money there. Not in the size that they're looking for, and there's a lot of leverage. That's why we're seeing a lot of money traveling around the crypto space. You're seeing those high volumes on token. But because there's a lot of leverage, you can take $10 at a 100, leverage on Maxi or some other platform. Yeah, so because it's a partially unregulated environment.
Okay, but I guess it makes sense to me as well that you'd have the big asset managers initially issuing and getting comfortable with the tech and kind of letting it sit there for a while and letting it be used for a while, and getting more and more comfortable with it to the point where they start holding it, buying it, and so on as well.
Right, 100%, yeah.
Yeah. Okay. I guess on the point you made about the new L1, that's interesting. Zero. I've kind of got my own views on this because there's another one that's become really popular, Hyperliquid. Right? I don't know if you've seen it, but it's a perpetuals exchange.
With a crypto like this.
Yes. Yeah, and I think there's two forces, like we're being pulled in two directions here, right? I think one direction is traders want the fastest product, right? They want the fastest way to trade. And so I think people in crypto and on-chain are trying to build the fastest infrastructure, right? And I think the other direction is the decentralization and the composability. So, if I end up with one entity running this whole thing, is it really different to NASDAQ? Have I really gained any efficiency? And can I still do this thing of taking assets over here and moving them around and maybe algorithmically doing that and so on? So I think we go back and forth with this. My personal belief as a techie is that ultimately we do end up in a decentralized world. So I think the Ethereum ecosystem or different layers of that and so on kind of make sense to me. But I can see why people want to own the whole stack and they want to make it as fast as they can as well.
It's Hyperliquid. It's a PEP market, right? It's perps.
It's perps.
Yeah. Perps are by itself a DeFi innovation.
Absolutely.
I don't think that I've seen a very big perps market. I don't know. I'm not an expert, but I don't think that I saw like a share or bonds perps market.
Right.
And I think this is part of the innovation that is going to trickle down to traditional assets. I think that Hyperliquid is very oriented towards DeFi traders, small retailers. I have a friend that trading there. He has all kind of strategies to collect you get like all kind of incentives to. So he has like this new delta neutral strategy that he does to collect the rewards, take the rewards home. Is not really a trader. So again, like this is, I think it belongs to the more early days. What we're seeing now with Zero, with this new blockchain, I know, again, I just read about it. I don't know a lot of information, but if it's really backed by Citadel and those big boys, and there's a chance that we'll see something really big happening there. And then, you can bring, innovation like Hyperliquid and other traditional finance, and I think that would be the win. This is where we're going to see like the real volume, the real adoptions, and so on.
Yeah, I agree. It's the perps is a real innovation. And the interesting thing, Hyperliquid, I mean, it's very fast. These kind of exchanges, they can be 10, 20 milliseconds because there's an order book that's on chain, but they're not trading the actual asset. They're trading derivatives. So it's really just order matching.
It's
it's
synthetics. Yeah.
But another interesting thing is the collateral is in stablecoin. So actually one of the biggest usages of stablecoin is as collateral for these perps dexes. Because the perps dexes they've taken such a lot of volume now. So yeah, it's interesting seeing the movements and how it's evolving. I agree.
It's definitely exciting to see this innovation. I think the difficult part for entrepreneurs in this space is connecting the two parts. How do you take something which is very fast, very liquid, runs freely, and you say, oh yeah, I'll take it to the real world, and then you start to understand how many layers there are, to protect consumers, to make sure there's no fraud, to make sure there's no illicit activity and so on. And the translation is a little bit difficult. Some of it, KYC rules is important, but some of it, especially like securities law, this is like really hindering innovation, right? Because each country has its own securities law, and someone can be qualified or accredited in one place, not in another. If you want to create something which is truly global, you need to hire a lawyer everywhere in the world where you want people to have access to, which is a little bit complicated. Still complicated. This fragmentation hinders financial innovation, but I think still happy that things are progressing regardless. The most important place in the world is still the US market.
It's the US.
Yeah, the US market is the biggest market, the most liquid, and also the regulator there is the most active regulator out of all the regulators. So once you're okay with the US market, then in the US market accept or embrace cryptocurrency, which they are at the moment, there's a room for a lot of innovation and launching new products.
Yeah. Do you think we could see global standards on this? Like, so major economies coming together and agreeing, some global standards and maybe legally handling this in a similar way, sort of consistency across jurisdictions to make it simpler?
I think that there's going to be a race, right? Yeah. So the EU started with the MiCA, very ambitious. I think that the European in general, they like regulations. The initial idea was not to impose additional regulation on crypto. The initial idea were, the US refuses to provide clarity on crypto. We'll provide the clarity, then everything would come to us, all those projects would come to us. So they enacted MiCA, and what happens a lot of time when you want to do something positive and eventually it turns out negative, it's in the world, the people that actually wrote MiCA were all blockchain enthusiasts. What can you do? You start writing it, and then someone said, well, what about privacy? And what about security? And what about securities law? And what about, and then how do you implement FATCA? And eventually, the burden of launching a product and licensing it become very heavy and just not worth it. So I think, they accomplished the opposite. Eventually all the project went to the US, and now the US has started to provide clarity, but they're not doing it through a very long legislation that applies. They're doing it more to allow their big financial institutions to move into this space. This is also, by the way, very smart. What they're saying basically is once we have those BlackRocks and others in the DeFi space, then it is basically becoming compliant. They would make it compliant because they are compliant. This would bring additional stability. So, for example, like FTX going down, Sam Bankman-Fried. The reason why you had FTX from the get-go is because everybody was so afraid about cryptocurrency. The NASDAQ on the New York Stock Exchange, they didn't want to go into the space. So there's some champion coming along and taking this and running with it, but they actually don't know how to operate a marketplace, right? And they don't know how to manage the budget. The small entrepreneur may be very smart or bright, but they have no idea what they're doing. And then one day,
or maybe they did, right?
Or maybe they did, or maybe they didn't. Just the compass was in the wrong place. Yep. The inner compass is in the wrong place, and then it collapsed, and a lot of people loses their money. So what the Americans said, at some point they said, what? If we had our own institutions that are been here for hundreds of years, if they go into this space, we won't see more of those FTX collapse, right? If we get those cryptocurrencies to register as securities, and right now we're actually seeing a lot of those, those DAT companies, digital asset treasury. What is it? That company is like, they're becoming those tokens becoming a traded instrument or through an ETF. Now you can invest with ETF. I can tell you with XTC, we just filed for an ETF on the token. And we also launched 2 products last year, one on Euronext and the other one on SIX Exchange. All our securities product registered, listed on a securities market, backed by the token. So, without sending anyone to jail, without chasing them to Greece, with the FBI and everything, we made the cryptocurrency ecosystem become more institutional, and we got the financial institutions to come into this space to make it more stable, more regulated, and people stop losing money.
It's you're right. I guess it's a lighter approach, right? And it's kind of in tandem with the industry as opposed to like specifying everything ahead, right? Which is maybe more the EU approach. The other way I look at it with the large institutions, what the US is doing is I look at blockchain from a tech perspective. So I think it's technically efficient, as you said at the beginning, right? As crypto was when at the time of the ICOs and NFTs and so on, you could see the technical efficiency. And I think if you bring your mainstream players and mainstream markets, you enable them to tap into the technical efficiency, then I think you open things up, right? And I think that's part of what they're doing. They're really saying, let's not stay, otherwise we're staying out of this. It's a little bit like saying, well, we're going to block everyone from using AI. There's a technical efficiency here, and that's going to allow things to be done quicker, faster, cheaper, and so on. And if you don't do it here, it's going to happen over there.
Yeah, and what's going to be the effect of it? That's also something that you need to. Yeah. Efficiency is not always good. If you're a bank and you have brokers, and brokers get a lot of money, 1-2%, I don't know, for a deal, that they make, but you have something that comes along and make things efficient, so you don't need a broker. Then maybe it's not that good for the bank to have this technology. So that's the nature of disruption. Right. This is also some of the reason why we see financial institution coming to the space, especially someone like Citadel. That's like cash machine, like a huge cash machine that just prints money all the time. That nothing can take it out. They are there because they're thinking that someone may steal their cake. And,
I think with the efficiencies, the question has to be if it's good for who. Right? Mm-hmm. It has ultimately the question should be about the end users.
Of course,
right? If it's good, if it's beneficial for the end users will go there if they can.
Yeah, 100%. I have no doubt. Again, I have no doubt. I see the way that my personal stock portfolio is managing versus my on-chain holdings, and you just cannot compare the two in terms of efficiency and yield and options and what you offered. And I have no doubt today that this is where the securities market, financial market, payment market, again, like There's revolutions that I think could not have exist without cryptocurrency and blockchain technology. For example, AI, you're going to have like agents running around doing all kind of tasks. An agent like that, you want to buy a subscription to a data source, want to transact with other agent that has specific knowledge on a specific product. How are they going to do that? By sending money from their bank, Barclays Bank in the UK to Citibank in the US and waiting 3 days for it to be confirmed that it's transferred, And also transactions are going to be very small transactions, going to be like in the cents or even less, Mm-hmm. How are they going to do that? There's only one technology that provides that. There's only one transaction that you can send a cent from one place to another without, waiting ages and, costing so much. So microtransactions and, on-chain currency is going to also to power AI revolutions and allow agents to buy and to interact with their environment. Again, this goes to the start of a conversation about speculation. Speculation is just saying that I think something would go out without having enough reasoning behind it. If you invest in 2020, 2018, you didn't really think that AI would come along and start using this technology, but that's the nature of it. And again, it's not investment advice. Not a big crypto holder myself. I'm just saying, that's that it's hard to predict the future. And sometimes when you see something that is really efficient and works really well, then it's going to be part of this image of the futures, how the future is going to look like.
Very good, very good. Ziv, thank you very much. That was super interesting. I think we covered a lot of ground there. Do you want to just tell us a bit about the event, just for people who want to join it?
In 10 days, 24th, 23 and 24th of February, 23rd, we're doing an evening reception and just to mingle, to meet people. This is like the networking part. And then on the 24th, we're going to have panels. I mentioned before the names. But there's also a lot of delegates. We actually, since I'm not an event organizer, what I hate about events is you go into events and just salespeople, trying to sell things, one to another. So what I did to combat that, I went to all those financial institutions. I went to BlackRock, I went to JP Morgan, and I just gave them free tickets. And I said, bring your friends. Meanwhile, it's not a speaker, but the sending representative, for example. So there's a lot of delegates, from the financial industry. A lot of interesting people are going to be there. You're going to be there. You have a really interesting panel, I think, with Shaltiel Elul. He's the guy that wrote the privacy paper for JP Morgan, a very highly regarded cryptographer. You got to have Avishai from Soda Labs, which is also a very highly regarded cryptographer. We have Dan Danai from Checkpoint, the head of blockchain for Checkpoint. Huge cybersecurity. By the way, this is some of the things that we started seeing. We had startup providing cybersecurity. Now we start to see like those very large enterprises moving into the space. So Checkpoint's going to be there as well with you in the panel. And we're going to discuss tokenization of yield-bearing instruments. We're going to discuss the future of this space. We're going to discuss collateral management. I actually got Anthony Woolley from Monera to host
another OG.
The collateral management panel. He's moderating, but he's also he's a highly regarded professional in this space. And the people are amazing. The speakers are amazing. And I don't think it's something to miss. By the way, we priced the tickets also on the low side. Sponsorship wasn't expensive. We just wanted to cover the cost of the event. We're fans of the space, not an event producer. Last year event was really nice. I know you enjoyed, and I think this year is going to surpass it.
Yeah, amazing. Looking forward to it.
Thank you.
Ziv, I don't know if it's going to be this year, but I'm sitting in Canary Wharf in one of the buildings in level 39. It's in One Canada Square, and next to One Canada Square, there's a piece of grass. Right? Sometimes they show Wimbledon, sometimes they have a skating rink, and it's surrounded by towers, which are Citibank, HSBC. I think might be moving out, but some of the others, the Bank of America, they're all there, Barclays. And I've kind of got this image now of you starting to dance, a few other people joining in, people coming down from the towers. So one day.
And then we built like big speakers, Armin van Buuren, so techno music. Yeah, we start dancing, and eventually people will join.
Love it. Amazing. Ziv Keinan, thank you very much.
Thank you.
Take
Bye-bye.
care. Take care.
Thanks for tuning in. Catch every episode wherever you get your podcasts. Follow Applied Blockchain on socials for the latest insights and explore our layer 2, Silent Data, at silentdata.com.